Reversal trades are very helpful kind of trades that can literally save your ass after you took a losing trade. They are also great if you want to participate on a trend or on a strong macro news movement. In this video we will learn what reversal trades are. I will show you the logic behind reversal trades and why they work. I will show you the market scenarios in which you can use them, and I'll also describe detailed rules on how to trade the reversal trades. So those are the reasons why I like the reversal trades, why I think they are so cool. With the reversal trades, you will be able to get your money back after a losing trade. You will be able to jump into a strong trend. This is sort of like a breakout strategy, but it's better than breakout, I would say. And with reversal trade, you will also be able to participate on a strong macro news movement. Before I jump into the reversal trades, let me first go through support becoming a resistance setup very quickly. It's a price action setup and it's very closely connected to the reversal trade setup. I know that a lot of you probably know the support becoming resistance setup. It's a widely known setup. It's not something that I invented, and this is how it works. Imagine this is a price chart and this is a price bouncing off some strong area. Let's say that this is the strong area the price jumps off. So this is a strong resistance zone, right? And when the price breaks this line, breaks the resistance and continues upward, the resistance then became a support. Alright, so it's no longer a resistance, but it is a support, and you expect the price to jump off this area. So this is resistance becoming support. It also works the other way. So imagine that this is a price chart and it's bouncing off this line, which is a strong support. When the price goes past the support, and the support then becomes a resistance. And then you expect the price to react this way, to jump off the resistance zone, right? So this is support becoming a resistance setup and the resistance becoming support setup. This is a price action setup, and we will be talking about volume setup. So there's not that big difference between support becoming resistance setup and the reversal trade setup. Only the support becomes resistance setup is based on price action, and the reversal trade setup, the logic behind the setup, is based on volumes. And you probably know that I prefer volumes because volumes are, in my opinion, the most important thing. So let me now finally show you how to trade the reversal trades. There are three ways or three market conditions under which you can trade the reversals. So the first case is when the price shoots past volume-based level. At this place I should probably mention that you should know my three setups, my three volume profile setups which I trade. If you don't know them, then I suggest you watch my free webinar. It's on YouTube. I'll put a link to it at the end of this video. So if you don't know my volume profile setups, just click the link at the end of the video and you will learn it quickly. But let's get back to this example. Let's get back to the reversal trades. The first kind of reversal trades is when price shoots past volume-based level. In the picture, you can see a trend setup, you can see a trend right there, volume cluster within the trend. This is setup number 2 from my volume-based trading setups. And usually this level works as a resistance zone. So in this case, I expect a reaction like this. But as you can see, the price just went past the level. It didn't react to the level. It went past the level without any reaction to it. So in this case, you wait for the price to return back exactly to the level and you enter a reversal trade. So if you went short from the level, then you enter a long exactly at the same price level and you expect a reaction to the long side. Alright, so whenever price shoots past volume-based level like this, without any reaction, then you wait for a pullback, you wait for the price to come again to this level, and you enter a reversal trade, you enter a reversal position. So this is the first way how to trade the reversal trades. The second way is when you want to jump into a strong trend. As you can see in the picture, there's also a volume setup. In this case, it's a volume accumulation setup. Pretty heavy volumes accumulated in this area. And there is a strong trend right there. Without any pullbacks, the price just goes past the level in a strong uptrend. And in case like that, you want to participate in the trend and you look for place where you enter the trade. In this case, where you enter a long position. So again, you wait for a pullback to the place where the heaviest volumes were placed in the market. In this case, it's exactly at this level. So you see the price went past the volume zone, then you wait for a pullback, and after that, from the same level, you enter a reversal trade, in this case, a long trade. This is how you participate on a strong trend. I need to say that you need to see some price action, some activity beyond your level. So you need to see some price action, for example, like this, above the level. Because sometimes it could just happen that the price goes past the level a little bit, then reacts to it and makes a reaction. So you don't want to take a reversal trade in case like that. You need to see that the price accepted the higher prices in this case. So you need to see some price action above the level, then you need to see the price to return to the level, and only after that you enter the trade. You don't enter a trade, for example, if the price overshoots the level 5 pips, then returns and you go long. No, you wait for confirmation. This is the confirmation. Let's say that, for example, if you trade intraday, the price needs to go 12 or 15 pips above the level, and only after that it is viable to take a reversal trade. Alright? Basically, you need to be sure that the price didn't respect the volume-based level. Alright, the third way to trade the reversal trades is to participate on a strong macro news movement. If you look at the picture, you can see this aggressive buying candle. This is a reaction to macro news. Obviously, you don't trade macroeconomic news. It's crazy to predict macro news, so you don't trade the news. You see, no trade. But still, the level that you had prepared, this volume-based level, in this case it's based on volume accumulation setup, it's still viable to trade only as a reversal. So you don't trade the macro news, you don't enter a short from this area, but you wait for the price to return back to your volume-based level, and you enter in the direction of the macro news reaction. So in this case, it is a long. You enter a long position from there. So you participate in the buying activity. You join the buyers, but you don't join them right there or right there, but you do it when the price returns to this level. You take a reversal from there. This is how you participate on macro news. You don't usually want to go against macro news candle like this one. This is a strong buyers pushing the price aggressively upward. So you don't want to go against them. That's why you don't enter a short. But you want to enter a long because you want to join them. Alright, I hope that makes sense. Now that I have showed you the 3 reversal trade scenarios, I would like to talk about the logic behind the reversal trades. You know, in my opinion, every strategy you trade should make sense and you should know the logic behind it. There are tons of strategies over the internet that tell you exactly what to do, what patterns to trade, what to do step by step, but if you really think about them, They just don't make any real sense. Those steps don't really make any sense. There is no logic in them. To me, it all seems like a bunch of random stuff, you know, and random stuff doesn't work. So always look for logic behind each trading setup. The logic behind reversal trades is this. If you look at the picture, you've already seen this one. So let me demonstrate the logic on this picture. Right there you can see heavy volumes of strong sellers who accumulated their selling positions there, and after that they pushed the price downwards. Because they pushed the price downwards, you can tell that those volumes belong to strong sellers. When the price makes it back to this area, you expect that those sellers will start selling and that they'll push the price downwards to defend their positions. But in this case, the price didn't really respect this level and it went past it. What it means is that buyers are really strong, that at this place they fought against those strong sellers and they won, which means that in this place buyers won. Buyers are stronger than sellers. And the buyers who won the battle at this area will be defending this place, because this is a significant place. You can tell if you look at the volume profile. So when the price makes it back, those buyers won't let the price go below this point. They know that this is a significant place, so they'll push again and they'll defend this area, this price level, and they'll push the price upwards. And that's the logic behind reversal trades. Let's now have a look at the rules to trade the reversal trades. Rule number 1, price needs to go past the original level. And then there is rule number 2, don't take the reversals when original level worked partly, original level got tested a bit sooner, and reversal level got tested sooner. Now let me talk about those rules a little bit more in detail. Alright, so this is the rule number 1. I already mentioned it, but let me repeat it so you have a complete set of rules. So this is a strong volume-based level, and this is the price action. Imagine that the price goes past the level. There should be S past. The price needs to go past the original level. And then it returns, and only then you can take the reversal trade. The price needs to go past the level. That's rule number 1. Next rule is don't take the reversal when the original level worked. So when there is a reaction to the original level, this is original level, when the price reacts to it, as it should, then you don't trade a reversal. So if, for example, there is a reaction, then the price makes it past the level, then you don't take the reversal. You don't do it, because the price already made a reaction to the level. Alright? The next rule is pretty similar. Don't take the reversal when the original level worked partly. This means that there was sort of a reaction to the level. It wasn't really significant. Let's say that it was, for example, just 7 or 8 pips. But still there was a reaction to the level. So if there was, for example, 8 pip reaction to the level, then if the price goes past the level, then again you don't take the reversal. Alright, because the price already made the reaction. It made a smaller reaction, but there was a reaction. So the level worked, and there's no point in trading the reversal. You only trade the reversal when the level doesn't get respected and the price goes past it. Another case where you don't take the reversal is when the original level got tested a little bit sooner. What it means is that the price approached the level, but it reacted a little bit sooner, let's say 1 or 3 pips sooner, and it made a significant reaction. So you can tell that this reaction was a reaction to this level. Alright, so when you see something like this, the level is already tested and you don't take the reversal. So after such a reaction, let's say the price returns, goes past the level, this is the level, then returns, you don't take the reversal from there, because the level already worked, only a little bit sooner, so you don't take the reversal. The last rule is don't take the reversal when the reversal level got tested sooner. What this means is when the price doesn't respect the level, it goes past it, and then you wait for a reversal. This is the level. You wait for a reversal, but a reaction occurs a little bit before the actual level. Let's say 1, 2, 3 pips sooner. Then it's already tested and the level is already spent, so you don't trade it anymore. So even if the price returns back to the level and actually touches it, you don't take a reversal, because the reversal got already tested right there. This is the reaction to the reversal. Alright? So that's it. Obviously, to trade the reversals like I do, you need the volume profile, because I trade reversals of strong volume zones, and you will find those volume zones only with volume profile. So you can get the volume profile from my webpage. I will leave a link to it below the video so you can easily get it. I hope you like the reversal trade tutorial, and I'll be looking forward to seeing you in some next video, and until then, happy trading!